Okay, everybody, so welcome to this morning's webinar on support and resistance and how to pick the levels that matter to you. In this webinar today, it should be a very exciting one because I'm going to show you one of basically the best techniques for making money from any kind of financial market, and it's really sort of the foundations upon which all of our trading strategies are built upon. We find that so many retail traders tend to get this wrong. And as a result, they end up getting into trades that are sort of the lower probability trades, and hence the ones that really don't stand that much chance of success. So in this webinar right here, we're going to show you, first of all, how to identify these levels. And then we're going to give you a few ideas as to how you can go about trading these levels. Before we get into it, I just need to go through the disclaimer, which is to say the content of this webinar is not investment advice. So we're going to be going through some pairs, and I want to make sure that you're aware that even when we go through some of the FX pairs, I may talk about trades that I'm in or trades that I'm looking at, but that's not investment advice. You still need to do your own due diligence, your own analysis. This is for educational purposes only, and spread betting and any other type of financial trading carries a high level of risk to your capital, of the possibility of losing considerably more than your initial investment. I think you all kind of get the idea there. There's risks involved in trading. I'm not going to bore you with that. Everybody has to own their own minds, but as long as you're happy with doing that, then I'm happy to continue. And what we will do right now is let's bring up the chart and we can start talking about support and resistance levels. So very quickly, who here uses support and resistance levels in their trading already? Who understands the concept of a support and resistance level? Or if you don't, that's not a problem either. That's what we're here for on this webinar. Okay, I'm going to assume that there's sort of like a good balance between people that understand it and those that perhaps don't. So a very quick sort of brief to those of you that perhaps haven't heard of support or resistance before and you're new to trading. Support and resistance levels, they're, in a nutshell, they're levels where the market has basically traded up to, whether that be to the up or the downside, and then it's found sort of like an invisible barrier, if you like. So for some reason, the price can't go any higher. So on this chart over here, if we were looking for resistance levels, we would say, for example, that this was a resistance level. We could say that this here, this is a resistance level too. Why are these resistance levels? Well, we can see that the market has moved all the way up here. We can see that there's been a big move here, and it's come up to a level where it fails to go any further. All right, so we've got this invisible wall here, and what that wall is it's a wall of sellers. So whilst the market's been moving up, the buyers have been having their day, right? They've been winning and the market's gone higher and higher and higher. And then it gets to a point where suddenly the market can't go any higher. Now, this can be for a number of reasons. It doesn't always have to be that you've got the opposite force coming into the market, as in, you know, you've got all of the bulls involved in the market while it's been rallying and then suddenly all of the bears get involved. It could be that the price gets to a level, okay, and instead of people that are particularly bearish on the market getting involved, it could be the fact that the people who were bullish, the people that were buying this move over here, so whilst the market was moving all the way up here, when it gets to this point and around this level here, it could be that the buyers are looking at it as an opportunity to take profit. All right, which is why you don't see the market move all the way back down here. Because if it was the sellers completely getting involved and saying, actually, we want to push the market back down, then you might see the reverse of what's happened here. But actually, you're just seeing a little bit of a pullback at the top here. You are seeing a reaction to a level, but you're seeing a little bit of a pullback in price. And what that kind of tells us is perhaps it's not the opposite side of the market getting involved. It's just all of those people that are buying aren't buying as much up here, and some people perhaps could be taking profit. On the other hand, if you get sort of like a more violent reaction to a level, so something like this here where the market's gone all the way down there and then it's come to a point and moved all the way back up, it's unlikely that all of this move here is going to be profit taking, right? If you look at this move here, It's gone from 114 spot 32 down to 10766, all the way back up again. So guess where? 114 around the 32 level. So it's basically retraced all of the move. Now, if the sellers here were interested in pushing this market lower, it's unlikely that the price would have been able to retrace this entire move here. So that already gives us a clue into the price action. That's telling us that actually, the price did want to go down here, all right? But then suddenly something happened and the sentiment of the market changed. And these are the things that you have to look at when you're identifying your support and resistance levels. Because a level like this, I'll zoom in a little bit. Oops. Let's get rid of the drawing tool for a minute. A level like this over here, so if we were to put in a support level here, that's going to be way more powerful than a level over here. It's just kind of created as a result of the normal price action, the normal fluctuation in price. Does that make sense to everybody? So this over here is going to have a much bigger impact in 3, 6, 12 months, 2, 3 years time than a little level like that. This is just as a result of the normal buying and selling in the market. This over here, something has happened at this point here to convince the market to go in the opposite direction. So the likelihood is if we get a move down to this level here, and it's a relatively harmonic move, which means it goes from this level here and it moves all the way down there like that, okay, and it's not sort of meandering down and slowly but surely going down. All right, if it's a concerted move down to this level here, it's unlikely that the market is just going to break through that level and go all the way down to these lows. It's more likely that there's going to be some sort of a reaction to that level. Now, how much of a reaction? Obviously, we don't know that. If we knew that, that would mean we have a crystal ball and everybody would be billionaires that's watching this, but we're not. So we have to take into account that we need to kind of exercise correct risk management. We don't know how much this is going to bounce. We can put in profit targets according to other support and resistance levels. But what we do know for sure, with a good deal of certainty, I should probably say, is that there's going to be some sort of a reaction to this level. It's unlikely the market is going to come all the way down here, okay, and it's not going to bounce up a little bit. So there's an opportunity there to make money from trading this level. So when it comes down here, if you were to put a buy order in at this level here and have your stop somewhere over here, it's from a probability perspective, it's highly likely that the market's going to bounce up at least a little bit. Okay, not necessarily all the way back up to then, you wouldn't want to see that, but a little bit before crashing down and breaking through this level. Of course, it's possible that the market could just crash through that level. The market can do anything that it wants. But as traders, what we're trying to do is take trades with a high probability of success. It doesn't mean we're going to be right every time. It just means that if we take the same trade over and over and over again, in the long run, we should come out ahead of the game and we should make money. Okay? Now, you could implement a strategy where you have a negative risk reward. So you might be looking for a 20 pip bounce here, but you'll be putting in like a 50 pip stop loss. That's okay too. You don't have to have a positive risk reward. You just need to have something that's clear and repeatable. Does that make sense to everybody so far? Everybody listening? Hopefully you're all on the same page as I am. So with that in mind, let's now start looking at identifying these levels of support and resistance. What time frame chart do you want to identify your levels of support and resistance on? Well, as a general rule of thumb, you kind of want to start on is at least the time frame that you're going to be trading, if not a higher time frame. All right. What I like to do for the Forex markets, and there's no right or wrong answer here, but what I like to do is I like to identify my support and resistance levels on the 4-hour chart. The reason for that is that I'm not taking positions that are going to be lasting, months and months and months. So if I were to identify my levels based on a daily chart, and they will be stronger levels on a daily chart, but my trades are going to be fewer and further between. So yes, I'm giving up some sort of strike rate. So the levels won't be as prominent as those on a daily chart, but it allows me to be in the market more often and hence make more money, from my perspective anyway. So I like to identify the levels from a 4-hour chart. The reason that I choose a 4-hour chart as well from an FX perspective is, yes, you get the long-term trends, driven by interest rates, for example, but you get on the daily charts, but you get the shorter sentiment-driven trends on something like the 4-hour chart. Right, so these things here, like this move up there, you wouldn't be able to take advantage of if you were looking at it from a daily chart because it wouldn't really look like a big enough move. That makes any sense. Whereas if we start looking at these on the 4-hour charts, we can already see just over here in the last month or so, we've got a bunch of different swings that we could be trading from. So how do we identify the supports and resistance levels? We want to identify the levels where the market clearly has turned around. All right. So what that means is some new traders would identify this, for example, over here as a support level, as a resistance level, sorry. That to me isn't a resistance level. The market hasn't really done much there. I'm more interested in these types of levels here, where the market has clearly come up to and it's turned around, or it's come down to and it's turned around and it's done something, right? I'm not looking for these tiny little levels here like that. It doesn't really mean that much, or that doesn't really mean that much. We're looking for significant price moves. Okay, this would be a resistance level for me. This would be a support level for me. This is a resistance level over here. Okay, and we can move on. So over here, this would be a resistance level. I would consider these two, because there's a double top there, as being a resistance level. We zoom out, so move back a bit. Over here is a support level. Over here would be a resistance level. So hopefully you're seeing a bit of a pattern here. I'm not looking for all of this stuff in between here. That's not what's important to me. What I'm interested in trading, okay, are the bigger levels. We want to be trading the levels where the market has had a reaction, because it's more likely that it will have a reaction the next time that it goes there. Okay, so there. So the next question is, once I've identified this level, right, I put these levels on my chart. How do I go about utilizing them? Because it's all well and good putting your support and resistance levels on your chart, but how do you trade them? Because obviously, oops, what have I just done? I've just changed I'll get rid of those things here. Oops. Because once you've identified the levels and the market moves away from it, how is that a trading opportunity? And that's a valid question for those of you that are new to trading. The answer is that the markets come back to these levels again and again and again. So if I go back in time, right, and let's say that, well, this is going higher, so this may be a problem. If I start putting levels on my chart from way back when, let's see how they're interacted with in the future. So that's a big level. That's going to be a big level. So is that. And around this sort of area here, there's another level. Over there, we have a level at this point. And now as we move forward on the charts, remember we've put the levels in from around this area here. So we don't know what's going to come after this. As we move forward, that previous level of resistance, what happens? We get a little bounce up in the market over here. Okay, would you have traded that? It's debatable. All right, not necessarily because the trend is down there, but you can see that there's a reaction to that level. Once the market breaks through it and it comes back to it again, where does it halt? Where does the rally halt? Around there again, and it sells off a little bit, not dramatically, The market, again, breaks up, moves up. What's the next level that it starts to mess around at? Around the same area as we had indicated in the past. And again, the market breaks through a level, it pulls back to it. Where does it start to turn around? At the 12467, which we identified all the way back here. So as you progress in time, you should be able to see that the markets interact with these levels over and over and over and over again. Right? The market's broken through here, had a little bit of a pullback. What level does it play with? The level that we already identified. It then breaks through that level and pulls back again. Which level does it play with? Another level that we had highlighted in the past. And now the market starts to break down. So we add more support and resistance levels, in the hope that in the future, the market will come back to this level and give us an opportunity to trade it. So when the market comes back here, what happens? It bounces from the level. Now, these aren't the biggest bounces in the world, granted. So you need to figure out a way to get into these trades close enough to the level that you have a decent chance of success. Whether that be a candlestick reversal pattern, some people would trade. So for example, here, you could have played the fact that you've got a bunch of dojis and spinning tops there, and when it breaks below there, you could have sold there with your stop above the high. That would have given you like pretty much a 2-3 to 1 risk reward by the time you get down to the lows. Not that you would have traded towards the lows, because no one does, but that's just to give you an indication. That's a very, very simple strategy. There's no real thought gone into that. It's just a well-known strategy in the markets. Okay, as the market moves up, do you find other opportunities to trade? Yeah, of course you do. Over and over again. And then after a period of time, sometimes these levels can become a little bit invalidated. And what you have to do is you then need to move your levels up to accommodate the new levels. So that one, the market was seesawing back and forth between that level, which is fine. But actually, by that point in time, we can see that there's a better, more recent resistance level that we want to play with. So we move the line up. And the market comes away from it. What happens the next time it comes back to it? It sells off from that level. How could you have traded it? Well, from a very simple perspective, again, we've got a doji at the top there. So if you were just trading a candlestick reversal pattern, you could have done that at that level. When the market breaks beneath the low of the candle, you have your stop above the high. And you can see that it pushes on down, down, down. And this stuff happens all over the chart all of the time. Right? The market comes down to this, well, it's a support level here. It was previously a resistance level in the past. We put that in ages ago. But we know that when the market comes down to it, it's likely to have some sort of a reaction. Therefore, we want to trade it. The market rallies up, it comes down again. Where does it stop before breaking through? The same level. Again, this stuff isn't rocket science. The problem is that retail traders or home traders, they feel like if the strategy is simple, it can't be great. There's got to be a super complicated strategy out there that eliminates all of their losses and puts 100% into their account every week. Unfortunately, it doesn't really exist, that strategy. And I know that that's what you're looking for. I was guilty of the same thing. You know, going back, well, dear Lord, I'm getting old now, 12, 13 years ago, when I came to the market, let's be honest about it, I came to the market because I thought this would be a great way to make some money without having to put, you know, too much effort into it. And if I could just find that perfect system that would eliminate as many losses as possible, and you throw indicator upon indicator onto it, then I'll be onto it. Then I'll be onto the win. But what you're doing by trying to filter out all of the bad trades is you're spending time on a task that you're never going to succeed in. You're never going to find a strategy that you never take a loss in. What you should be doing is spending your time learning to trade a strategy that's not perfect, but it's good enough. And learning to control your emotions so that you can come out ahead of the game. You know, Nikki and I, recently, that's my brother. Well, not recently, over the past year or so, we've been developing a strategy for the retail trader. All right. What we've been doing is we took a step back and we said, you know what? Well, actually, it started because we were doing a mentor program for our community. And one of the ladies there, she said to us, she loves the way that we were teaching her to trade equities, the stock market. And she compared it to some of our other FX courses and other FX courses, or not ours, that are out there in the market. And she said to do with this mentor program, the thing that I love about your strategy for trading stocks and equities is it's like learning to drive. This was the analogy she gave. She said, with your currency trading programs or like your DAX program or others out there, you can see that it works, but you have to be very, very good. So you can't just learn to drive. You have to be a Formula One driver to be able to make money from it. And that was her opinion, and that's fair enough. She said, but with this equity course, you don't have to do that because you've given us a structured approach to looking at the market that removes a lot of the discretion. You just go from one step to the next step to the next step. And as long as you follow all of those steps, you should end up in a trade which has a higher probability of success than failure. So that got us thinking, is there a way to have such an approach in the Forex markets? And then we thought about, well, if we're going to find that approach, we should probably try and find an approach that counters all of the issues that a retail trader faces. Things like they don't like to be wrong too often. Okay, can we eliminate all losses? No. But can we find a system where you have less losses and you have winners? Absolutely, we can. Retail traders, sometimes they're not in the right position at the right time. They might be in the wrong position, in the right position, but at the wrong time, so their timing sucks. How can we counter that? And there were a bunch of other things that we looked at. And then when we came down to developing the strategy, we thought it was going to be, overly complicated to try and cater for all of these needs. But you know what? Coming full circle, the strategy that we've developed is actually very, very straightforward. It's very simple. It's based on the stuff that I'm showing you here in this webinar right now. It's based on support and resistance. At the core of the strategy that we came up with for our members was support and resistance levels, trading from one level to the next. And you can build a strategy just as effective. Okay, if you're willing to embrace this. If you're willing to embrace the fact that you're not perfect, neither am I. But if we can find a system that's simple, repeatable rules, then you're going to put yourself on the right side to be able to make money in the long run. So let's talk, before we have to wrap it up in about 15 minutes time, let's talk about a strategy that you could take away right now, okay, to trade from your support and resistance levels. Once you've identified your support and resistance levels, why don't you do something where you look to trade in the direction of the trend from one level to the next, or thereabouts. But you only do it once you see interaction at a level. So for example, when the market moved down here and it moved up, as you can see here, so we've got the markets moving down. It's making lower highs pretty much and a couple of lower lows. So we have an expectation that the market's going to move lower. What you could do is wait for the market to come down to this support level again, which it does here, and wait for it to interact with that level and kind of create a mini support level at that support level. So for example, it would be this area here. You'd bracket this range, you'd say, okay, the market looks like it's going to break to the downside. When it does eventually break that, so if we get a candle move beyond there, so on this candle here, I'm going to get involved in the trade. I'm going to put my stop above the high, and I'm going to look for the market to move down towards the next support level. Okay, well, that's quite far away. That's sort of like a 5-to-1 risk reward. So maybe you could even say into the mid area of that level, so somewhere around here. And even with that, the risk that you've got from here to here versus a reward that you've got from there to there is very, very insignificant in comparison. And that's a very, very simple strategy that every single one of you could implement right now. And you see it work all over the charts. You just have to be patient. So this one here, for example, we wait for the market to come back to the level and start to interact with it. What that means is we want the price action to start hugging that level, start to trade around that level, which it does here. It doesn't matter which side of it is. So this one was the other side of the level, and we were trading basically a break through the level. Over here, the market's already broken through the level, but it started to move sideways over here. At that point in time, you can then buy the market with your stop beneath the low. And again, you don't need it to go all the way up towards the highs over here. You could have it trade around the mid-level. So somewhere around there. And you would have got approximately 2-to-1 on your trade. How easy is that? Seriously, how easy is that sort of a strategy? Is that something that you feel that everybody here would be able to utilize? You just type a quick yes or no into the chat box. Yes. Doesn't need to be complicated, does it? And you know the fantastic thing with this sort of an approach? You can use any charting platform out there. So I had an email coming just this morning actually saying, like the idea of your new strategy, can you give me an indication of whether you need to trade it on MT4? Does it need a bunch of indicators? And I'm happy to say that because it's just based on support and resistance, like this stuff here, no, you don't need indicators. You could trade it whether you're on a Mac, whether you're on a Windows PC, whether you're on an iPhone, an iPad. This sort of a strategy can work on any of those because it's just based on a plain price chart. Something that anybody can get their hands on. Whether you install it on your machine or you access it through a browser. So I'm using TradingView right now. I love TradingView because I have all of my charts and I can access it from any one of my computers. Right? Are there any questions? Or should we go through some other examples? I'm going to pull up the euro dollar chart. I'm going to mark up this chart and see how we could have traded it. So let's start from back in time. Start from around this area here, right? No, John. So John's saying, does it have to be with the... It's not a daft question at all. All of them are valid questions. No, it doesn't have to be with the trend. If you're trading with the trend, then you just kind of have that little bit of extra confidence because you got the rest of the market with you. But no, ultimately, if you're trading the strategy, you could trade it against the trend as well. If you're just trading the reactions to the levels. Okay. If you've got other questions or if you need me to clarify, let me know. What I'll start to do anyway is I'll start to mark up the chart here. So this is Euro chart. All right. So we're going to mark in the major levels of support and resistance. Now, sometimes you get this dynamic where you've got a support level there, then a little bit high, you've got another level, then a little bit high, you've got another level. What I do there is I kind of just move it somewhere in the middle of all of those levels. So if the price comes up to around that area there and it starts to give me some sort of a price pattern, then I'll still be willing to trade it. So they're areas of interest. Now, excellent, John. It should be the way forward for you. It should be the way forward for everybody if they want to be successful in the long run. Okay, so look at this, by the way. So I put in this support level from this here, which you would have put in. So let's say I had these, right? Let's see how it reacts to these levels. The market breaks through this level. What does it do? It pulls back to that level and pulls away from that level. So you've got an opportunity to trade it. Where does it react before it breaks down? It comes back to this level. reacts around that level. So you could bracket that and take a sell through that area there, right? The market, we have this resistance level in from over here. What happens? It comes up to this level. You'll get sort of like a 1, 2, 3 reversal at that level there. That would be an opportunity to sell as well. And it happens over. So there again. There again. There again. Now you don't trade all of these. You need to wait for the right price pattern, right? But it should show you that these levels that we created back here, look at the market react to them. Are you joking? Are you joking? Look at the way the market reacts to these levels here. Yes, it breaks through, but it didn't spend any time above it. That's a great shorting opportunity. What about here? You can't actually make this stuff up, can you? And it doesn't need to be complicated. The key is to pick the most obvious levels out there. If you have to squint and turn your laptop on its side or your monitor on its side to try and find a level, it doesn't exist. We're just looking for the most obvious levels out there, right? So going forward in time, what's an obvious level? Well, we've got one down here. We could move this up a bit because this is the most recent significant level. We can move that down a little bit. That area there. You don't need to argue with that, is it? Do you? You know that the market is turned around there. The market's come down here, so reacted to that level again. That same high that has been in since all the way, way back when is still here, and the market is still reacting to the level. You just need to pick the key levels, the ones that matter, where there's been a clear reversal of price. Okay, so for example here, it's pretty significant. The market came down to this level, then completely pulled back. The market is reacting to what levels? Same levels we've identified. Again, and again, and again. Absolutely not rocket science. Very simple. Very simple and so effective. And it actually amazes me how many traders out there don't trade this way. They're looking for that super complicated system, which you absolutely don't need. Everybody can make money like this, as long as image is okay. Yep. What was I saying? Yeah, you don't need to overcomplicate it. It's like, you could print these charts up going all the way to before there were computers. I wasn't alive then, but well, I was alive a little bit before then. But I hear that people used to print up their charts and use a ruler on pieces of paper to pick levels like this. It's the oldest way of trading. It's the most effective way of trading. And this is my gift to all of you today. If you take nothing away from today other than say that your trading does not need to be complicated, the simpler it is, often the better it is. And I know that us as human beings, we tend to value things a lot more if it's more expensive. We value a lot more if it's more complicated, right? We think if it's more complicated, then we'll be willing to pay more money for it, for example. But it's not always the case. Sometimes something as simple as this that you can find for free all over the internet, supporting resistance trading, is the most effective. The problem is that it's hiding in plain sight, right? Whilst we're looking for the magic system, the magic indicators, we'll look at our charts and we'll be like, oh, that could have stopped us out there. I wonder what indicator I could throw on my chart that would have stopped me getting into this trade here. Okay, because it would have been a loss. And then you throw an indicator on your chart and it would have kept you out of that trade, but then it also keeps you out of this trade, which would have made you money. Uh-oh, what do? Then you break your system. You're not even trading according to your system anymore. Okay? And then you're making mistakes. And then you're cross with yourself because you're making mistakes that aren't even according to your system. And then you're kind of in this downward spiral that we've all faced. You're not alone. We've all made stupid mistakes in the market. We've all had bad periods in the market. You don't beat yourself up about it. You just need to try and be a little bit objective about things. Take a step back. Look at your trading. Look to see where you've been making the mistakes. Make things less complicated. And I promise you, everybody will improve as a result of that. Even if you have another strategy, use the support and resistance the way that I've showed you here, or shown you here, I can't even speak English, to filter in or filter out your trades. If the trade doesn't present itself at a level of support or resistance, don't take it. It has a lower probability of success. Even if you have a super duper system, take your trades from these levels of support and resistance, and I guarantee you your strike rate will go up. It's impossible for it not to, because whilst you're taking trades in the middle over here, so in the middle of these support and resistance levels, the price movement is pretty random because you've got no reason for the price to do one thing or another. You don't know what the markets are looking at. If you're doing it at support or resistance levels, you know that there's going to be some sort of a battle there. And then you can use price action to help you get into or out of the trade in the right place. And hopefully at the right time. So we have a few minutes left. Are there any questions at all? Is there anything that needs clarifying? Or is this relatively straightforward and you're ready to kind of throw this into the markets and start taking your trading on to the next level? Is this burst done No, this is done manually. So you train your eyes to look at this stuff. So I know that it seems difficult in the beginning, but I promise you in the long run, it will pay off. So, has everybody enjoyed this webinar here? Do you feel like you've got some value out of the 40 or so minutes you spent with me this morning? I hope so. Excellent. So what we can do on our next premium webinar, if you like, is we can talk a little bit more in depth about specific strategies that could be utilized by trading from support and resistance to levels. So I can give you a few different ways of getting into and out of the markets. So we can build on what we've learned in this session here. Does that sound like a plan? Excellent. Not at this particular moment in time, John, but I will speak to FX Street and we will find a date. But it will be in June, no doubt about it. And tell your friends. Friends and family, anybody you think can benefit from this. Let's start a movement of support and resistance traders. Okay, so thank you so much, everybody, for joining this morning. I really appreciate your time. So excellent, John. Thank you very much. Thank you for your time. If any of you need to contact us or you've got any questions at all, please feel free to go across to our website, which is www.traderscorner.co.uk. There's sort of like a form at the top there where we're giving away our free Forex masterclass where we talk more about this kind of stuff. We also talk about some strategies for getting into and out of the markets And one of the best things that you'll get from that as a result of that is you'll also get our email address. And then you can feel free to ping me any questions that you have about this. So hop on over to traderscorner.co.uk. And yeah, sign up there. Then drop us an email of any questions you have. We'd love to hear from you and we'd love to help you. Thank you, FX Street, for putting on this webinar. It really is very much appreciated. And I look forward to speaking to you all on next month's webinar. Okay? So take care now and have a lovely day's trading.